What's up, guys? Hex pays you on average 38%, but where does the yield come from? The yield comes from inflation. Since the yield comes from inflation, doesn't that mean it's bad for the price? Isn't that going to drive the price down because they're inflating the supply? So while it is obviously one factor, inflation is not the only variable that determines the valuation of a cryptocurrency, regular currency, or any other asset for that matter. So what determines valuation? It's the supply and demand. It's not that complicated. So if there's more money on the buy side and less money on the sell side, then the price will go up. If there's more money on the sell side and less money on the buy side, the price will go down. So not all inflation is created equal. And Richard Hart talks about this all the time. In the case of Bitcoin, where does the inflation go? It goes to the miners. When were the biggest gains in Bitcoin to be had? During the time of its highest inflation. Now, why is that? Back in its early days, you were able to earn 50 Bitcoin for mining a block using your CPU or GPU. So if you're on your laptop, you were able to mine 50 Bitcoin blocks. Is there any expenses? Is there any overhead for mining Bitcoin on your laptop? No. So if there was no overhead, you were less likely to sell it. You didn't have to pay for anything. What happens when you don't sell it? There's less supply and more demand, and the price goes up. Today, in 2022, can you mine Bitcoin on your laptop? Absolutely not. You need expensive computers that consume astronomical amounts of electricity. You also need a warehouse to store these computers. You need employees to maintain the warehouse, to maintain the mining. You also need accountants for filing your taxes. And what do these all have in common? They cost money. It's called overhead. How are you going to get that money? You're going to have to sell the Bitcoin that you mined. What happens when you sell your Bitcoin? The price shoots down, which is why Bitcoin goes up in price every 4 years, because the amount of selling pressure from the miners is coded to get cut in half. What about Hex? Where does the inflation go in Hex? Inflation goes to the stakers. Do you need a giant rack of ASIC computers in order to earn your interest staking Hex? No. Do you need a warehouse to store your T-shares? No. Do you need employees to maintain your warehouse and your T-shares? No, the overhead for earning the inflation in Hex is zero. What happens when you don't have overhead? You don't sell as much. What happens when you don't sell? The price goes up. What happens when the price goes up? More people want to buy. What happens when more people want to buy? The price goes up. It's simple supply and demand economics. It's not that complicated, and that's why Hex was able to do a 10,000x in under 2 years. So why did the price drop 95%? And it's dropped over 80%, I believe, 5 times. And the answer to that is there is sell pressure. That's early investors. But if early investors have so much Hex and it's staked over the course of 15 years, coming out on a regular basis, shouldn't that lead to a permanent sell pressure and the price never going up and possibly going to zero? And now this is where the law of diminishing returns comes in. And it's extremely important you understand this for investing in cryptocurrency and any other asset for that matter. Now, what is the law of diminishing returns? The more you have of something, the less it is worth to you. So if you have one house and you buy another one, the second house will not be worth as much as the first one to you. You're not going to need the second house because you already have the first house. And if you buy a third house, then it's worth even less than the second because you're going to be spending less time in it because you already have the first and second house. And this law applies to pretty much anything: cars, clothing, planes, etc. So let's take, for example, Mr. Early Hexagon. Mr. Early Hexagon is 25 years old, working at Walmart, earning $18 an hour, and living by his parents. Mr. Early Hexagon takes $3,000, puts it into Hex, and ladders it out over 15 years. By the time his first stake is up, the price has gone up 10,000x, making it worth $2 million. What does he do? He'd probably market dump his bag, leaving him with 30% slippage, so $1.4 million. He buys a house, he buys a Lambo, he buys some cool clothing. He has $500,000 left to live on. His second stake comes up, he still has $300,000 cash in the bank. Price of Hex drops 50% and it's worth only $1 million. So let's say he market sells that, gets the 30% slippage, walks out with $700,000 and has $1 million total in cash. But he already has his house and Lambo and cool clothing. He buys more property, he buys dividend stocks, he buys equities. By the time his third or fourth stake comes up, he's going to already have significant cash flow from all the other investments he put in. He's going to have yachts, multiple Lambos, multiple properties, as well as other businesses and investments he was able to make. while we don't know exactly what he'd do, you can conclude he will be less likely to market dump his entire bag. So now he's going to start cashing out maybe a little bit on a limit order and then restaking the principal or the principal and some of the interest for maybe 15 years. He also might want to take a loan against it so he can extract liquidity without paying anything in taxes. He can also provide liquidity on decentralized exchanges and earn the rewards token. So overall, the more money he earns through Hex and his other investments, now that he has a lot of money in cash, the less likely he is to sell his Hex because it appreciates over time and pays probably a better yield than any of his other assets. So if he's not going to sell and the price goes up, the price goes up, more people want to buy, and the price goes higher. And obviously it has corrections because there's always going to be people taking profits. But overall, this creates a great positive feedback loop, ensuring the price goes up astronomically in the long run. And this is exactly why Hex was able to do a 10,000x in under 2 years. So when you say that the price of Hex is never going to go up over time, because early investors are just going to want to dump on the new investors. The reason why you're saying this is because you're likely a pleb, and that's what you would do in this situation because you don't have any money. You don't have houses, you don't have cars, you don't have women, you don't have cool clothing. So you are likely to dump your Hex on the market because your returns have not diminished yet, because you haven't had a 10,000x in under 2 years. However, either now, because I explained to you how this works, or if you buy and stake Hex, not financial advice, do your own research, there may come a time where you realize that people with a lot of money are very, very unlikely to dump their fastest appreciating and highest yield paying assets, which is why real estate goes up over time, good stocks go up over time, and good cryptos with product market fit go up over time and at a faster rate than any other asset. And in my opinion, not financial advice, why I believe that Hex will continue to appreciate over time despite the inflation, as well as the fact that early investors have huge bags. So to recap, is inflation bad for the price? Not necessarily. In fact, sometimes, like we see in the case of Hex, it can actually be good for the price. In Bitcoin, it goes to the people that sell, so it's bad. In Hex, it goes to the people that do not sell, so it's good. The law of diminishing returns states that the more money you have, the less you need, and the less you need, the less likely you are to just market dump your highest appreciating and greatest yield paying assets. If you like what I have to say, please like and subscribe and leave a comment. Show me that what I'm doing is meaningful. I'm trying to create videos as much as possible, and the more engagement I see, the more likely I am to keep this content coming. Thank you.